Hello and welcome, everyone. It is Scott Schilling. Sorry for last night's interruption. We were about 18 minutes into this webinar and all of a sudden hit a power grid spike, shut down my computer, shut down everything. So my apologies. So I thought, well, instead of working to do this live, I would just record it for you all and send it back out to you. So let me hide my screen. This is financial planning and why you need it. Let me go ahead and share my screen and get things going and make sure we are recording. We are. So thank you so much for joining me. We're here for financial planning and why you need it. So I want to just say hello and welcome. If we have not met, my name is Scott Schilling. And I'm extremely passionate about helping people wrap their minds around, quite frankly, how financial planning works and why it is so important to understand how it works. Unfortunately, most schools don't teach a class in how to handle your finances. So the majority of Americans don't really know the first thing about how to handle their assets. And that leaves them in a very vulnerable situation to those who do understand the system. Today, I hope to break down some of those barriers so that you can prepare for your future and, quite frankly, the future of those you love, your loved ones, and those who count on you in a financially responsible way. So, again, normally we would be doing this live. This is recorded, so you can send me any questions that may pop up. Normally we would post them here. Unfortunately, because of the power surge, this is a recording, but please feel free to send me any questions to scott@scottschilling.com, and I will get back to you as quickly as possible. So, what is a financial plan? A financial plan is really a comprehensive evaluation of your current financial state, as well as what your future financial state might look like. A plan is created by using all the currently known variables to predict future cash flow, asset values, and even withdrawal plans. But you're probably asking yourself, why would someone need this? Well, money makes the world go round, and having a plan for your future will help you sleep better at night. I can vouch for this myself. Most people work in conjunction with a financial planner or somebody who has some expertise in the area. But even if you do that, it's great to have the knowledge yourself to be able to audit that work. Now, you do this to understand your current net worth, maybe your tax liabilities, your asset allocation, future retirement, or even estate plans in developing these financial plans. These are all metrics that are used along with the estimates of asset growth to determine if a person's financial goals can or cannot be met, what adjustments need to be made. It should be said that there is no specific template used to develop a financial plan. Basically, it's everyone's financial situation is incredibly unique. Now, before we go too deep in this, I want to lay out some terms for you that I'll be using throughout this webinar. These are fairly basic terms that you'll encounter, but I want to make sure that you have a pretty good understanding of the meanings. The first is asset. An asset is a useful or valuable thing. Some can include properties, goods, valuables, even collectibles. Those are all assets. The next is allocation. It's the act of distributing an amount or portion of the resource to a particular recipient. So if you gain an allocation of your assets, it would be a distribution of a portion of your assets. Fiduciary. This is a person or organization that owes to another the duties of good faith and trust. Many times these are money managers or bankers or accountants or board members. Even corporate officers can be considered fiduciaries. Again, I encourage you at the very least, get this knowledge so that you can audit those who may be fiduciaries in your behalf. They're supposed to do everything in good faith and trust. Unfortunately, not always the way it works. So having this knowledge is really important. Investment, an item of value you buy to gain income or to grow in value. Individual retirement account, IRA. Now, I'm going to give you a list of sources later on for those of you who want them. And there's actually more definition about the IRA, the individual retirement account, in there. Liability is a financial responsibility or obligation. One last word, trust. A trust is a fiduciary relationship in which one party, the trustor, gives another party, the trustee, or potentially the fiduciary, the right to hold property or assets for the benefit of a third party, who is known as the beneficiary. All right, so where do we start? In order to get your affairs in order, you have to list out exactly what you're working with. Now, this means figuring out where all your money is. Or in other words, where are your assets? If something were to happen to you or you were forced to pay a due or a fee, but you didn't have cash, the first thing that would be taken are the other valuables that you have, the other assets, such as maybe a house or a car. So by listing out everything you own, and you can include your house and your car, land, property, maybe expensive jewelry, art, antiques, collectibles, or anything else that you have that may have significant monetary value. The next thing that we look at is, what do you owe? Well, what could that mean? What loans do you have in your name? Do you have a student debt? Maybe credit card debt or a mortgage? How much do you owe? These numbers actually should be fairly top of mind if you're financially fit, if you truly have control of your finances. If you don't know these numbers off the top of your head, that is okay. But again, better to know them and to be on top of them. You can get the information if you run your credit score. Can be done online, free. There are a couple sites such as credit.com or Credit Karma. A couple places you can get that. Now, this step, and quite frankly, the last step, is part of figuring out your personal net worth. And we'll get back to that soon, so don't get overwhelmed. I don't want to do that to you or for you. The next is, what's in your future? There are some questions that you should definitely be asking yourself. These are financially related questions, such as, do you want children? Children have a price tag to them, not to buy them, just to grow them, to raise them. Are you planning on continuing your education? Do you have family members or loved ones that you might need to financially support? Is there a potential that maybe you'll be getting an inheritance? Do you plan on selling any big ticket items? Maybe a house or some collectibles or land. Do you plan on buying any big ticket items? Do you have any health conditions at this time that could affect your financial situation down the road? Unfortunately, bankruptcy due to medical expenses is the leading cause of personal bankruptcy today. Hate to have to think about it, but this is part of the planning process. So take note of your answers to the questions that I just shared with you, because they'll become very useful in putting your plan together. So are you struggling with your finances? Well, if you are, you're not alone. You are not the Lone Ranger. I want to make this point to lay down a couple statistics, and I want to lay these statistics out for you because I know talking about money can sometimes be scary, or you can even feel a little shameful about it. As we continue to go through this webinar together, I want you to be aware of financial situations and maybe even those of your peers, so that maybe you can feel a little bit less stressed, or at least realize that if you're struggling with money, you are certainly not alone. So let's get started. Now, in case of emergency, according to research from the Associated Press, 2/3 of Americans would not be able to come up with $1,000 in an emergency. Now, the amazing part is this is including families whose income exceeds $100,000. Here's the good news, though, is that even a little bit of savings goes a long way. $250 to $750 can help families avoid eviction, missing a house payment, or other financial downfalls. This is according to the analysis from the Urban Institute. Of course, in a perfect world, a true emergency fund would take care of 3 to 6 months of expenses. So make sure that you mark that down. 3 to 6 months is the target for your emergency fund. When it comes to debt, the average American is in way over their heads. Now, here's a breakdown for the average debt per household as of 2017, according to data from the Federal Reserve. Credit card debt, average household, $16,883. Auto loans, $29,539. Student loans, $50,626. Mortgages, $182,421. And on another note on debt, specifically credit card debt, paying the minimum on your credit card balance will saddle you with more interest than you can really dream. That's not a good dream, by the way. That's more of a nightmare. In fact, the average household pays over $1,300 in interest each year. So try to be strategic and wise when using a credit card for purchases. Again, we've all had our periods of time, me included. One of the reasons that I teach this is because I need to hear it myself as well. So let's get back to the plan itself and setting some goals. When you're thinking about your own financial plan, it's important to set specific goals. A financial plan is based on an individual or family's clearly defined financial goals, including funding a college education for your children, or buying a larger home or a second home, starting a business, getting ready for a retirement, or even leaving a legacy. These goals should have specific budgets attached to them and be set to milestones for tracking. For example, maybe one of those milestones is at age 65, you want to retire with $600,000 in savings. That's an achievable and a definable milestone. So now your personal net worth is a snapshot of your assets and liabilities of where you are today. This is used as a benchmark for measuring your progress moving forward. So as we're setting up net worth statements, it's as easy as creating a checklist and really doing some simple math. And although it might be stressful and take a little time to fully complete, figuring out your net worth builds the foundation for you to have an understanding of your current financial situation. And it gives you a reference point for moving forward. Now, again, I will provide the sources and I'll actually provide you this checklist. If you want to reach out to me and get that checklist, I would love to share it with you. So we need to look at cash flow, the analysis of our cash flow, and where is it going, and develop a retirement strategy. Sounds a little intimidating, right? Well, all it means is, where's your money going? What are you bringing in, and what are you paying out? Essentially, are you just building a budget, or is this going to help you determine what your options are for the future? My parents, growing up in the Depression, actually cashed their checks and put an amount of money in plastic dividers. The gas bill was this and the this was that. Now, I'm not encouraging that right this moment, but I'm just saying I have seen various budgeting systems throughout my life, and that's why at least I saw it. I don't know that we uh, see a lot of opportunities like that these days. This brings us kind of to the second piece of this, and that's creating a retirement strategy. Um, this is your plan for building a retirement fund so that you'll know how you'll be distributing that money back to yourself for the rest of your lifetime. Basically, building a budget for how your financial situation will look after you stop working or adding to your retirement funds. Determining this will involve some time and understanding, and maybe a 401k or even an IRA. And again, we'll talk about that more here in just a little bit. Okay, so you know what are potential worst case scenario? Okay, so this will be a little dark, but please bear with me. You've got to address these things. Creating a comprehensive risk management plan means thinking about where your money goes once you're not able to take care of it anymore. To do this, you work with either a financial planner or a fiduciary or an executor, some people around you that you can trust, to identify all the risks and exposures and really provide necessary coverage to do that. Now, what would that coverage look like? Well, it would be a full review of things like life insurance or disability insurance, personal liability coverage, property coverage, casualty coverage, and even catastrophic coverage. Then you get into estate planning itself. Now, this is the part that you have to do the thinking about the worst case scenarios, because every aspect of estate planning might not apply to everyone participating in this webinar today, just so you know, but I want to touch on it anyway. As I mentioned before, many Americans are not in the financial position to deal with estate planning. That's totally okay. Totally get it. But if you are, here are some of the things you need to know and really start to critically think about. Estate planning involves deciding how your assets will be handled upon your death. This includes things like assigning your power of attorney. That's the person who makes your legal decisions and directs how the assets and investments will be handled. You have to accommodate things like funeral arrangements, establishing an annual giving program if you want your money or assets to be donated to a particular organization after your passing, establishing a guardian for any living dependents, setting up trust accounts. These are all things that you should gain some knowledge on, even if you're working with professionals to set these things up. You having the knowledge and being able to audit this information is tremendously important. Creating or updating beneficiaries on plans like this, such as life insurance and IRAs and 401ks, that's all part of this. So again, you really need to be personally involved in this, even though it is taking care of those you love or those who count on you. So let's break down a little bit about a trust. A trust is used to protect assets and direct them into the right hands and it survives after your death. Setting up a trust is safer than leaving money to a family member to hold, as an example. The trust specifically defines the distributions, when they can be taken, can't be taken, things like that. Even with the best of intentions, your family member or a friend could face a lawsuit or divorce or other misfortune in which that money could then be put at risk. You had a design for it. All of a sudden, after you've passed, other issues come into play. Setting up a trust ensures that your money will be out of your hands, hidden from the IRS, meaning protected to the greatest legal possibility. When the tax laws were written, the little sidebar here, it was for us to pay the lowest legal amount of tax. So therefore, understanding tax code, understanding what that lowest legal amount is really something to strive for, because that means that you can pass on the proceeds from what you've earned throughout your life. Now, we want to do this all so that your beneficiaries gain the greatest possible amount. Now, this is all outlined in the legal documents, obviously. Essentially, creating a trust is a way to control your money while it's technically and legally out of your hands. So again, very important way of doing it. Now, investments are very interesting. Making an investment is exactly the same, many people say, as gambling. There are tons of factors to take into account depending upon your individual situation. So, but if you're interested in investing, here's some of the questions that you should be asking. How does the investment work? A good way to test this is to see if you can explain how it works to someone else. What are your goals? Are you looking for safety or income or growth, or a combination of all three, quite frankly? What are the risks? Are you comfortable with taking those risks? How much do you expect to earn? Is it a realistic number? Is it simply pie in the sky? How long do you plan to invest? Now, is this a short-term investment or a long-term investment, or maybe somewhere in between? What are the costs to buy, hold, or sell the investment? Will you pay taxes on the money that you earn in that investment? There are vehicles that allow you to earn tax-free. Those are great. Some are pre-tax, some are post-tax. These are all valuable questions to ask. What other investments do you already have? How does this particular investment fit with your other investments? Do you understand? The more education you have on this, the better off you're going to be. Even if you don't execute all the strategies yourself, having the knowledge to audit is important. What about family planning? Now, we touched a little bit on family planning earlier and how it's necessary to consider whether you want to include children and how many children into your financial plan. But here's some important facts to really understand. And again, I've never heard of a high school or college class that addresses this, quite frankly. According to the U.S. Department of Agriculture, the average cost of raising a child, now this is the 2013 information, from birth to age 18 is roughly $245,000 to $304,000 adjusted for inflation. It's $250,000 to raise an 18-year-old. Wow, that's pretty amazing. And oh, by the way, that doesn't include the cost of college or their college education. If you're deciding to have a family or you're currently expecting a child, I'm very glad that you're here, because quite frankly, childcare costs need to be put into this account. You need to study these kinds of things. If you want to know a little bit more about this research or really a legitimate breakdown of monthly costs. Uh, there's a calculator involved in the sources. Uh, in other words, an expense calculator. I would love to share that with you. Simply send me an email at scott@scottschilling.com and ask for the expense calculator, and I'll make sure you get that in the resources provided with this webinar. How about speaking of dependents, whether it's a child or another family member or a loved one, those whom you're financially responsible for, quite frankly, life insurance is a must. Having life insurance to cover coverage helps ensure that your loved ones will be able to maintain their standard of living should you pass away or become disabled. I actually started my career as an 18-year-old life insurance agent while going to school and playing Big Ten football. I've understood the value of life insurance for many, many years. It really allows your family to live the life that you have planned together, provided you plan. So how much coverage do you need, and what kind of policy that you need depends on your family's monthly expenses, your net worth, your income. And again, there's another calculator available to you. Love to share it with you. Just send me an email, scott@scottschilling.com, and I'll send you all this support documentation and material. So let's get back to the basics. So now that we're covered by life insurance, we've looked at our worst case scenarios. We've looked at a couple other stressful topics. I'd like to switch over to maybe a little bit of a lighter note. Let's talk about ways that you can save money. Well, how about step one? Getting your budget on track. We've already talked about this a ton, quite frankly, and I know it's on your mind. Just make sure you get it done. Budgeting your money is the cornerstone of a sound financial plan. Even if you think you're good at managing money, wouldn't you rather be 100% sure, quite frankly? Make a budget, then stick to it. If it's hard, find out where you're spending a little bit extra. In my book, That Sucks, What Now?, I talk about a friend of mine who gave his son $1,000 a month. Now, his school was paid for, his room was paid for, his food was paid for. That was $1,000 a month in just spending money. And what he came to find at probably 3 weeks into the month, he was out of money every month. And we even had the conversation, how can you spend $1,000? What are you spending it on? And we found out that when he actually studied where his resources were going, he was spending on average $735 a month at Starbucks. Now, I'm all for Starbucks and I'm all for good coffee, but if it interferes significantly with your goals for the future, your life at the present, might be something you want to consider. Just a thought. Step two, learn how to reduce spending. It's funny. I forgot that this was here, but do you need to spend $5 every morning for coffee? How often are you buying lunch from the cafe at work? And can you really afford to do that? Do you go out for drinks every weekend? Laying out your spending habits will really allow you to prioritize what's important to you and cut back on the rest. Now, do you have any experience with writing out your own expenses? And if you do, the question would be, was that productive to you? I'm betting it probably was. So let's take a look at saving some more money. Let's continue. How could we do that? Well, step three, deal with your debt. A credit card can be a great tool for dealing with finances, but it's important to use it with care. Before you go spending money that you don't have, know the difference between good debt and bad debt and how it can affect your credit score. Again, in the resources, I'll supply some places you can get this information. Step four, saving money means that you need to spend less money than you earn, which is easier said than done for the vast majority of people. I get that. The easiest way to do this is to work with your bank to set up automatic savings accounts so that you automatically transfer a set amount from your checking to your savings each month. That's a good way of doing it. It doesn't have to be a ton of money. Even a small amount of money is better than nothing because it then starts to compound. And compounding is an amazing wonder of growing worth. Step 5, trim your taxes. Even if you don't make that much money, you'd be surprised when you learn how certain tax strategies and decisions can impact your finances. This entails learning a little bit about the tax code. I understand that. And it's pretty complicated. I also understand that. But there is plenty of research that simplifies that. Again, available to you. Simply reach out and request it from me. I will actually get it to you. One of the things that I suggest, and people talk about home-based businesses. Many times people don't understand. If you don't understand the tax code, you don't understand the value of having a home-based business. The tax code says you have to have an intention to make a profit. It does not say you have to make a profit. Now, you do eventually with your business. That's true. There is a time frame dictated in the tax code, but you have to have an intention to do that. But now things are tax deductible because you have a business. Similar activities can be done. In other words, going to lunch with a friend and talking business. In either case, whether you have a business or don't have a business, you are having lunch. If you legitimately talk business to that friend, it now becomes a tax deduction. So even though you spend the exact same amount of money, the net difference works to your benefit. Again, don't want to do a long tax lesson here. I've got other resources for you available. And again, I encourage you, if you want to get a hold of the resources, obviously a fair amount of study and effort has gone into producing this webinar to get you the most current information that I possibly can. It's also available in my new book, That Sucks, What Now? Real world solutions for getting through what you're going through. Jack Canfield, the co-creator, co-founder of Chicken Soup for the Soul, was gracious enough to write the foreword to the book. It's almost 200 pages of really wonderful information on how you can take back control of your finances, how you can learn some of the things that we've talked about today, and then also other areas of life and business. It's available at tswnbook.com. Now, let me give you one of the values for buying it. For the moment, when you buy this book, simply buy the book. I will gift you a $100 gift card for simply buying the book. Now, I'm assuring you, you're not paying $100 for the book. So do you understand? This is one of those financial decisions. Not only do you get all the content from the book, all the information from the book, but you are also rewarded for taking that action. My encouragement to you is to go to tswnbook.com and take advantage of that. I just want to say thank you so much for joining me today. I know that your time is extremely valuable. I love getting to meet the folks that are on the webinars. Again, please feel free to reach out to me. Hopefully you've learned some valuable information here. We're going to continue to do additional webinars on life topics, things that are extremely important. I also want you to know how proud I am of you for taking the steps towards being more financially secure and financially fit. To learn more about some of the things that I discussed today, please go to BeFinanciallyFitToday.com. There's a plethora of information there. And if you have any questions or you want to ask me anything in particular, please reach out to Scott at scottschilling.com. That's SCOTTSCHILLING. So again, we're done for now, but ultimately the bottom line is you're just getting started. I really enjoyed our time together. I've had a number of you already reach out with questions, so I'm really excited that you're doing that. Please do. The only bad question is the unasked question, quite frankly. Leave notes, leave comments, and or just send me what you think is your number one takeaway from our time together here. Also, if you need any support in the journey, I'm here. I coach, I train, I speak, I help however I can. I'd be more than happy to help you. Again, please feel free to reach out to me at scott@scottschilling.com. I certainly appreciate your time here today. Really excited that we've had this time together. Thank you so much for being here. God bless.